selling ever since.
Right.
Smart beta has got to be the second best naming there's ever been. It's just marvelous. Now, does it mean anything?
Yes.
Does it really mean anything of value? That's a different question.
All right, let me try one more approach, Charlie, before you can tell us what we should be doing. And that is, you have been on the board of some very successful financial institutions, and you have certainly, been in an advisory capacity for the Yale Endowment, which has one of the best track records of any endowment in the country.
Absolutely.
And they're active managers. So why can't, we participate in something like that? Are there other firms that, that have mutual funds that we can do, as well or at least better than the markets, as the Yale Endowment has done?
No. I mean, it's very disappointing to many people, but
right.
The truth of the matter is you can do better than other investors by indexing. You'll do much better than other investors if instead of worrying about individual mutual funds or individual stocks, you think carefully about who are you and what's your reality. Do you have enough income so you're saving money? Are you young enough so that you can think in terms of 50 years? Are you able to learn enough about investing so that the ups and downs of the market don't matter and they don't disrupt you and cause you to get nervous and tensed up? Are you able to avoid, after a bad market that's been bad for a year or two and everybody's writing about how bad it's going to get, are you able to maintain calm and stay long-term knowing that these things do happen fairly often and that if you don't react, you're fine?
Of course,
all those things are really important.
Right.
And then how much time are you willing to spend on thinking about your family and yourself and what you're trying to do? And if you just could focus on those things, you can do yourself a world of good. I mean, really a major advantage.
But for our audience that don't have the luxury of a 60-year time horizon or whatever of investing, and
wait a minute. I look at myself, for an example. You say, Charlie, you were in your late 70s. You don't have 20 years. Okay, so I don't have 20 years. What am I doing making long-term investing? First of all, I would like to be sure that I've provided for my beloved wife, wonderful person, something I feel very serious about. I have children. And
right.
Son of a gun, they have children. And the idea of my children and their children being able to get a good education appeals to me. And I think that's a nice thing.
But for retirees, for instance, in our audience, who basically want to make sure that they are able to support themselves in retirement.
Let's focus on that group.
Yes. So focusing on that group, many of them hold mutual funds, and many of them probably hold several mutual funds. Should they be switching to index funds at this point? I mean, what's your advice?
Well, they shouldn't switch to index funds unless they would like to reduce the cost of activity, and they would like to increase the rate of return that they're enjoying.
Right.
And they'd like to stop being nervous about the market and individual stocks. And the investment organization they're working with now might get acquired by some gigantic insurance company, as often has happened over the last 25 years. If they want any of those things, but if they like to pay high cost, and if they like to be worried about individual stocks or individual managers, and all of that sort of stuff, and they don't mind coming in behind the market averages on a regular basis, and sometimes getting really schnockered, that'd be fine. But I haven't met those people yet.
So you're saying that basically all of us, no matter what stage of life, if we're investing in the market, we should be in index funds.
Let's say all of us.
Right.
I still think that Warren Buffett should not.
Right.
I still think David Swensen at Yale should not. And there are half a dozen other endowments that I feel the same way.
Right.
Certainly there are people who are absolutely marvelous at this kind of work who can, because of their experience, history, and their knowledge of individual people and their relationships, they can do slightly better. But they don't do a lot better. They do slightly better.
Choosing your index funds, what's your recommendation there? Because there are a lot more index funds out there. I mean, I know you've been a long-term advocate of broad diversification. So, Vanguard, you used to be on the board of Vanguard. They certainly have some funds that are total stock market index funds. Is it a one-stop shopping decision?
Pretty
Yeah.
close, but let's take it seriously and go through
Yes.
the drill. Number one, if you're at all sort of, I just want to do some, the S&P 500 or the equivalent, a broad, diversified index fund. Focus on low cost and be sure it comes from a well-known, experienced provider of index
Right.
funds. And there's several. BlackRock does it, State Street does it, Vanguard,
Vanguard does it. Right.
So, if you wanted to be a little bit more up to speed, rational, doing the right sort of thing, you should probably think in terms of more diversification, and you should probably have about half in US stocks and about half in international,
international,
stocks. Now, broad diversification is a good phenomenon. You might also say, well, I don't have as many little companies as I would like to have, so diversify in that direction.
Right.
That's fine. Whatever you're doing, just be sure that you say, I plan to stay with this for the long, long time.
So your view on ETFs probably is what? Jack Bogle doesn't like them because
Well, Jack gets all upset about
Right.
people trading. And
right. Yes,
he's right.
exactly. So, but your view on ETFs is
I personally think you should be a very long-term holder, and therefore, why should you pay for the privilege of being able to get in and out? Therefore, why not just go to an index fund?
what about other asset classes? Bonds, for instance, commodities.
This is a theoretical question, Billy, but I believe deeply that if you're going to invest, you should be only interested in buying things that have a capability of increasing value by what they do, economic value added. I do not think that you should buy paintings to make money. I do not believe you should buy barrels of oil in anticipation that the experts who price oil are making a terrible mistake and you're smarter than they are and you could make a bundle by buying low and selling high. Do not believe anybody should buy gold in order to make money on gold. If they like to look at gold, that's fine. If that's their joy and pleasure to see it.
Or as a
If there's some
non-correlated asset.
anxiety they've got that there might be an invasion of the Martians and we might have to get out of here and you better take something that's valuable, that's lightweight, fine. I'd prefer diamonds, but it doesn't make any difference to me because I wouldn't do either one, wouldn't dream of it. Because I do believe that the world's going to work out.
But
And I
bonds.
do believe whatever you're investing in should be something that has productivity.
Right.
Now, bonds, I tend to be very independent, and I have to caution you. I believe that most people have longer than they realize and can live through more than they think they can. And a little bit of practice, a little bit of studying history, they will be less anxious about things going up and down on their way through. And I would be more happy if more people would think more seriously about being more equity invested. And I think the cost of being in bonds, because the return is lower long term, the cost of being in bonds doesn't get fully recognized. I'm going to give you a personally strong held view. Teach a class at Yale on investing called Successful Investing. Students are asked on their first day to come prepared to answer the question, what percentage asset mix would you have at 30, 50, and 70? And the answer is 30% in bonds at 30, 50% at 50, and 70% at 70. There must be somebody that's got that on the internet. And then I say, why? And they say, because. And I say, no, that's not a good answer. This is a graduate studies at a great university. Why? And this awkward shuffling about that's not a fair question to ask, and you haven't even taught the course and you're asking final exam questions. Let me consider something. Do you have a whole picture of your finances? What do you mean by a whole picture? Well, for an example, you're going to get a job. How much would I have to pay you now so that you would give me every dollar you earn for the rest of your career? Jeepers, I'm not selling. No, you assume for a minute that you're going to sell, and all you have to do is set the price. What do you think would be a fair price? And it turns out to be a gigantic amount.
Right.
I said, okay, What is your salary most like? Is it most like a stock or most like a bond? Well, it's more like a bond. Fairly predictable, doesn't flutter day by day, and so on and so on. So that's intellectual property. Your talent, your ability to earn a salary is pretty close to being a bond portfolio. And what fraction of your total wealth is that now? It's always 99.9 something percent. Why would you take the small amount that you've got in securities and jam that into more limited income or fixed income? Why shouldn't you put it into equities? And then what you realize is, until you get to be pretty far down the curve in time, you probably ought to keep more than you would have thought out of bonds and into other investments.
Very interesting. I wish I could take the class. Final question, which we ask every guest on the end of a Wealth Track interview, and that is, if we had to own one investment for a long-term diversified portfolio, what would it be?
Index fund, broadly diversified, low cost.
That's great. Charlie Ellis, thank you so much for being with us once again on Wealth Track. Congratulations on your new book, The Index Revolution. Thank you.
A treat to be with you.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point involves Charlie Ellis's core recommendation for all of us. It is to spend some time and carefully think about who you are and what your reality is. What is your reality? What are you trying to do for yourself and your family? What's your savings plan? How long is your investment horizon? Can you handle the inevitable market fluctuations without freaking out? And unless you are really into managing your own investments, choose a basic indexing strategy and stick with it. As Ellis says, that choice will ensure you will outperform the vast majority of professional and individual investors. To spend some more time with Charlie Ellis and hear why he is so optimistic about the future, go to our website, wealthtrack.com, and click on the Extra feature. The website also gives you access to past interviews and action points. And to personally connect with us, keep reaching out on Facebook and Twitter. Thank you for watching. Have a great weekend and make the week ahead a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Thornburg Investment Management, Active Management Global Perspective, Rosalind P. Walter, and the Fairholme Foundation.